All right. Well, everybody, thank you for joining us today. Hopefully, you pick up something helpful as you manage your finances and all that. But yes, I'm Cindy Tarosky, and I am a partner in the Bonadio Group's tax service area. But my focus is as a CPA financial planner is in providing knowledgeable, objective advice in all areas of personal finances, and it's on a professional fee basis, not managing money. And that's for individuals of the firm or not. They don't have to be clients of the firm. So this could be estate planning, retirement planning, charitable gift planning, any ad hoc questions, anything that individuals have when they're thinking of all areas of their personal finances. So in doing all that, we have a unique background that enables us, with the blend of tax CPA and CFP, that enables us to simultaneously weigh up the financial, the tax, the accounting aspects of everything that we do so our clients can make more fully informed decisions. So anyway, that's enough about me. So let's dig in. So you'll notice this is part one, and you saw that in the invitation. So the second part will be May 15th. So this one is focused on you and your IRA that you either contributed to during life or rolled over an employer plan into, or both. So this will be more about you. And, IRAs are a valuable retirement asset, and it's good to know the rules. You want to avoid penalties. You want to know what you can do to better manage it and plan. So hopefully, I figure everybody's, usually in doing something like this, there's a wide range of familiarity with the rules. But if everybody can walk away with even one tidbit that's helpful, then that's a good day for you and for me. So let us get into it. All right, so the importance and benefits of IRAs. So they provide another vehicle for retirement contributions that can either be on their own if you're not in an employer plan or to supplement an employer plan. And it doesn't matter whether the contribution's deductible or not. That's not what determines whether you are eligible to contribute. There's a lot of confusion out there about that. They think if they don't get a deduction, they can't make a contribution. That's not the case. So even non-deductible contributions still grow tax deferred, and they provide tax basis later on when you go to take withdrawals. It gets spread out amongst the whole balance, and retirement accounts, IRAs, and qualified plans all grow tax deferred. So we just got through tax time. We know we got those 1099s, interest, dividends, capital gains. But of course, there's none coming from your IRA because it's growing tax deferred. There's no tax until you take it out if it's a traditional IRA. So you don't have federal and state coming and taking a chunk of your earnings. So it truly is intact to compound. So let's say you put in $1, earns 10% in some markets, not right now. And that $10 now earns 10%. So it keeps snowballing. So that's where you can often accumulate more wealth on a tax deferred basis than you could if you had it invested in a regular brokerage account. And then also think about, some people have invested in some individual stocks that have had some crazy run-ups over these recent years. But if it's in a personal brokerage account, now we have to think, oh, how do we unwind that, or how do we realign everything, because there's tax implications. The nice thing is with these IRAs, that is not the case. You're free to reallocate however you need to. And that's important because actually that's one of the biggest reasons or driving forces for what your allocation or your total return is over time. So yeah, you're free to realign as you need to, no tax impact. Having an IRA, you also have a traditional IRA, you also have flexibility to do Roth IRA conversions, if that makes sense for your situation. I'm going to talk more about that later. You also have the opportunity to make qualified charitable distributions, also known as QCDs, from an IRA, and I'm also going to talk about that in a few slides. And it helps fulfill your estate planning objectives if you do careful beneficiary planning, beneficiary designation planning. So I'll touch on that as well. And continued here. IRAs also provide asset protection from most creditors, and that doesn't count the IRS. They always can come and get it, or alimony, child support, that kind of thing. But this all varies by state. So New York provides pretty generous asset protection for IRAs as they do for qualified plans. For bankruptcy in New York, it's up to $1.7 million that's protected for bankruptcy on on IRAs at Roth and traditional. And that does not count for inherited IRAs. They're not protected in bankruptcy because they never really are your retirement account. So qualified plans, if you roll them over to an IRA, that account follows the same rules as it would for a qualified plan. In that case, it has full bankruptcy protection in addition to the same creditor protection. Good to know, because asset protection is an important aspect of your assets, because we're in a lawsuit happy world. So good to know. If you ever need to go on Medicaid, this is good for you, or you think of your parents. The balance isn't counted for Medicaid if you're in payout status. So that means you are taking required minimum distributions each year. And the same actually applies to Roth IRAs, even though you don't have to take required minimum distributions. But if you put yourself in payout status as if you're required to take a required minimum distribution, it's considered in payout status, and the balance is protected the same as a traditional IRA. That varies by state. So I can speak about New York, but the other states you have to check with your local laws. And it could have better payout options for beneficiaries, especially where we now have Roth accounts inside 401k and 403b plans, where you can have tax deferred growth in them. But if you pass away with a balance still in one of these plans, and it's a mix of pre-tax, meaning it hasn't been taxed yet, traditional, or the Roth account, it's less advantageous for your beneficiaries to keep it in the plan. So in that case, it forces the Roth component of it to be distributed over there's a 10-year payout rule that I'm going to go into for accounts inherited after 2019. So Roth IRAs on their own don't have any distributions during those 10 years, but they do if they're inside, if even $1 of Roth is mixed with pre-tax in a qualified plan, then that beneficiary inherits that account, has to take distributions over the 10 years, and accelerates getting it out of a Roth IRA, which you want to keep it in there as long as you can. It's tax-free growth. And I'll talk about that in a little bit too. It's a great way to benefit working children. So they have to have earned income by making gifts to an IRA, or even better, if they can qualify for a Roth IRA, if their income's not too high. That just adds up over time. And think of all the years of compounding over a child's life expectancy. And due to these benefits, it's worthwhile to consider tapping non-retirement accounts first when you need cash, either before your RMDs start, or if you need more besides what your RMD amount is. And that leaves more of the IRA intact to compound tax deferred longer, and for all these other benefits that we just talked about. So that's a way to manage it when you're in retirement, is to think about, okay, that's one of the first questions that come up when somebody retires. Where do I draw from first? So that's a consideration when you're thinking of your priority order. I do also have some people that think, my RMDs are going to be so big later, I'm going to start taking it out sooner. And we'll talk more about that, but that can be where a Roth conversion has a similar impact without getting it out of a retirement account wrapper and subject to income tax each year on the earnings. Okay, so the rules have been crazy. I'm so glad you guys are attending this. There's not much change in rules for IRAs and retirement accounts for so long, and then starting in the Secure Act of 2019, that upended all the rules, and then it just snowballed from there. So it's been a crazy few years, and the rules have completely changed, both for yourself during lifetime and for those that inherit your account. So hopefully you learn some things that will help you better manage everything, because you need to be aware of these rules. And you'll have the materials We will be sending out a copy of the recording and the slides afterwards, so you can always refer back to this if you need to. Okay, so we're going to talk about just some of the changes, the key points that would be good for you to know. I can't talk about all of them. That would be here for weeks. So the age limit was removed. That was the original Secure Act change in 2019. That's the age limit for making contributions to traditional IRAs as long as you have earned income. Roth IRAs didn't have an income limit. Traditional IRAs did, but they took that away and put them on even playing field here. So as long as you have earned income, you can still make contributions, again, whether they're deductible or not, to a traditional IRA. And, a lot of people are working longer, especially business owners. They seem to never retire. People are working longer because, the years in retirement can be so long. So hopefully they're doing it because they want to and not because they have to, but still might have earned income past 70 and a half. But that has an impact on the qualified charitable distributions, which I'll talk about, like I said, later. But the QCD amount that you can do gets reduced if you made any contributions to a traditional IRA after age 70 and a half. So there's a calculation that has to be done when preparing your tax return and when you're making this contribution. The RMD age was increased. It used to be 70 and a half forever. And then they raised it. One of the laws raised it to 72, and another law raised it to 73. So age 73, and by 2033, it'll be age 75. So if you haven't turned age 73 by the time you get to 2033, then you're going to be subject to your RMD age won't be until 75. I think it's for anybody born after 1960, but I can't do the math right now. So there's also a special catch-up contribution for those that are age 60 to 63, and that started this year. That applies to qualified plans, but there is a type of IRA listed here that it also applies to. So I want to make you aware, and I want to make everybody aware. So if you're involved in participating in a 401k, 403b, governmental 4057 plan, you can make an extra between those ages, 60 to 63. You can make an extra $3,750 contribution to the plan in addition to your $7,500 that you can contribute when you're age 50 and over. And for a simple IRA, that extra amount is $1,750. So that's in addition to the regular $3,500 catch-up contribution that you can make if you're participating in one of those plans. So that's nice. They're trying to get everybody to be better prepared for retirement. And that's what these law changes are all about. So the Roth accounts, so that's inside a 403b or a 401k plan. If you are participating in a Roth account, you contribute to a Roth account within one of these plans. It used to be that you had to take required minimum distributions from that account, like you do the other part of the account, the pre-tax traditional part. No longer the case. So that started, I think, in 2024. RMDs are no longer required from employer plan Roth accounts, and that puts them on par with Roth IRAs, which makes sense. Also, the penalty got reduced for failing to take. So if you fail to take your required minimum distribution in the right amount, or at least the minimum amount, and in the right timing, the penalty used to be 50%. Now the IRS in this law did bring it down to 25%, just still hefty. And if you correct it within 2 years, it can be dropped down to 10%. Now, when it was 50%, the IRS rarely enforced it as long as you had a reasonable basis for it. And we don't know now, with it being lower, if they will more regularly enforce the law and there will be less wiggle room to get out of it. So that remains to be seen. Either way, nobody wants to pay penalties. So you got to pay attention to these rules in order to avoid that. This one is one of the biggest areas, and this impacts your decisions on naming your beneficiaries, which I'll go more into later towards the end of the presentation. But the changes here were apply to your beneficiaries. So it used to be that when a beneficiary inherits a retirement account, they could stretch the distributions over their whole life expectancy. It didn't matter how old they were. they could then take a small amount. They're required to take a small amount out, and then they could always take more. But that's the minimum. That got changed with these laws. So no longer do you get the stretch to take it over your lifetime, and most non-spouse beneficiaries don't get that anymore if you inherit a retirement account after 2019. So most of those beneficiaries have to deplete the retirement account within 10 years of the account holder's death. So if they die in 2023, by 2033, it has to be fully distributed out. That often accelerates the tax and cash flow implications to the beneficiaries, maybe more so than you would like. If you think about some of these balances, that could be millions, and your beneficiaries are getting it out over 10 years. So from a cash flow perspective, maybe you don't want them to have that much in that amount of time. And certainly, who knows what their tax situation is, but that would compound their tax situation to have such big distributions and have so much money coming out in a short time period. So that takes careful planning on your part during your life and on the beneficiary's part during their life. And session 2, we'll talk more about that second part for the beneficiary's life. They must take required minimum distributions during that 10-year period if the original owner, say you, died after your, sorry to use terms, but they matter, required beginning date. That is not the year you turn RMD age, which I mentioned is 73 or 75 later, but April 1st, the year after. So it's a very important date because it determines what happens next for those beneficiaries. If they die after that person's required beginning date, then they must take those required minimum distributions during the 10 years and have full payout by the end of the 10th year. So this is where they have to say, all right, how much? I only take the minimum for these 10 years. Do I accelerate it in certain years? Depends on their tax situation. There's no RMDs during the 10-year period if the account owner, say you, died before your required beginning date. So if you're well before you have to start taking RMDs, they can wait the full 10 years and then distribute the account all in the 10th year if they want, if that makes sense tax-wise. Roth IRAs, on the other hand, have no required minimum distributions during your life, and there's no required minimum distributions during the 10-year period after you die during this 10-year period. And so they can wait until and they should wait until the 10th year, and the distribution remains keeps its tax-free treatment as it did to you. So cash flow wise, they can wait until the 10th year if that makes sense from that perspective, but tax wise, it won't compound their tax situation. So no big deal if they take a big payment in the 10th year. There is a class of beneficiaries that was newly established by the Secure Act in 2019 where lifetime stretch is still available, and that's to what we call eligible designated beneficiaries, EDBs, or certain trusts named as beneficiary on your IRA for their benefit. These individuals are, the classes are your surviving spouse, a disabled or chronically ill child, a minor child, which is defined to be under the age of 21, and it has to be of the original account holder. So not of your child. It has to be your child, not their child. Until they turn age 21, and then that child is subject to the 10-year rule also, and they have to take RMDs during that 10-year period. Or it could be a beneficiary not more than 10 years younger than the account owner, so that might be a sibling or a cousin or something like that. Now, if you name individuals as beneficiaries on your IRA and you have a mix, some that are these 4 classes of eligible designated beneficiaries and some that are not, it taints it. So nobody gets the lifetime stretch payout. Everybody falls under the 10-year rule. So this is where it gets important. Do you have these mix of classes, and maybe you separate, you can have multiple IRAs, and you have an IRA with beneficiaries that are just eligible designated beneficiaries in these classes, and you have one that's naming other beneficiaries. Or you can have a trust that provides for all of them, as long as the trust breaks out into has subtrusts that break out into trust for each of them individually at your death. And then you just name the trust, and you can have a mix that way. So this is where it's important to understand this rule so you can think of how you want to structure your beneficiary designations. This rule didn't change, but it's important to know because we'll every now and then see how people structure their beneficiary designations and they don't realize the implications. So if you have a non-designated beneficiary, a non-person, you either don't have a beneficiary, or the beneficiary, whoever you've named, is a non-person, then there's different payout rules. So this could be where you name your estate, and some people actually name their estate as beneficiary outright on the beneficiary form. Or it might be deemed to be your estate because you name someone, maybe you didn't name contingent beneficiaries, you name a primary, that person dies before you. So you really have no beneficiaries now on your account unless the institution has some kind of default that backs, puts somebody in there by default. So if you have no beneficiary, you left it blank, or they predeceased you and you don't have the various people named, that would be considered to be your estate. Or if you have in your will or trust agreements that and you name the IRA as beneficiary to the estate, or a trust as beneficiary, and the agreements, whether your will or a trust agreement, allows your estate taxes or debts to be paid using the IRA, that's considered to be the estate as your beneficiary, whether you meant to or not. Charity, if you name charity as a beneficiary on an IRA or retirement account, or you have a trust that doesn't qualify as what we call a see-through trust. You can't see through to the individual beneficiaries of the trust to be able to see their life expectancy. That's considered a non-qualified trust. That's a non-person and would get the rule this payout rule, which is a 5-year payout if the account owner died before that required beginning date, which is that April 1st after you turn RMD age. 5 years, pretty quick. Or you can use what's called the ghost life expectancy rule the beneficiaries could use your remaining single life expectancy in the year of death. If you died after your required beginning date, and then take that life expectancy, look at it once, and then -1 every year thereafter, and that's how they would figure out their required minimum distributions. So it's important to know this is where naming contingent beneficiaries is so important, because maybe you don't want to fall under this 5-year rule, or your life expectancy, depending on who you name as beneficiaries, might be a lot shorter than who you were going to name. And now it's over your life expectancy or the 5-year rule. Important to know. You don't want unintended consequences. That's the point. I'm mentioning Key Secure Act changes that affect 529 plans because there is one that affects Roth IRAs that many have heard about, but also this is important to know. So there's for federal purpose, tax-free qualified expenses now include K through 12 tuition up to $10,000 per year. I can speak for New York. New York's 529 plan doesn't count that as qualified, so there'd be recapture of income tax benefits. Certain expenses for registered apprenticeship program that is qualified in New York for the 529 as qualified expenses. Up to $10,000 per lifetime, not per year, of qualified education loan repayments for a beneficiary and their siblings. That's considered qualified for New York just recently. Rollover to a Roth IRA of a 529 beneficiary. So it has to be for the beneficiary who's named on the 529 plan, rolled into an IRA, their Roth IRA. That is now qualified as of this past September as a qualified expense or qualified distribution. I have an article on our website that goes all into that and the rules and considerations, because it doesn't mean that is what you should do. There's more, of course, to the story. So let's take a look at the types of IRAs. Many of you might know these, but I'm going to cover them anyway. There's the traditional IRA, where the contributions are maybe tax deductible or maybe they're not, but the withdrawals are taxed if you got a deduction going in. There's the Roth IRA, where contributions are not tax deductible, but the withdrawals are tax-free, including earnings. I just think of that compounding I talked about over all the years. especially young people. No RMDs are required during the owner's lifetime, and they can withdraw contributions tax-free, penalty-free anytime. So I bring that up because when younger people are considering how much they want to put into these, or you're doing it for your children, knowing they could get it back out if they had to, they don't have to wait until retirement. The earnings have to stay in, but the contributions can be taken out anytime. But there is an income limitation for being eligible to qualify for contributing directly to a Roth IRA. Some people, if their income is too high, and they didn't realize it, and they made this contribution to a Roth IRA for themselves or their child, and then get to that tax year's tax return and realize it was too high, you could take the money out and earnings, or better yet, you could avoid the penalty if you recharacterize the contribution and the earnings to a traditional IRA rather than withdrawing that excess contribution. That assumes again, you had earned income that allows you to do that. That wasn't why you were disallowed. You have to have enough earned income and haven't already maxed your contributions. So there's a spousal IRA. It really is just a regular traditional or Roth IRA, but it's for a non-working spouse. I keep mentioning you have to have earned income, but a non-working spouse can count their spouse's earned income. So as long as there's enough to count for the two of you, you can make your contribution, max it, and make one for your non-working spouse. So that, again, can add up over time. So it's worth doing if you have the cash flow for it. You have to be filing a joint tax return to qualify for that. And then there's these small business self-employed retirement plan IRAs that I do want to mention. One is a SEP IRA, Simplified Employee Pension Plan IRA. For employers to contribute to employees' IRAs, it can be you are the employer and the employee if you're self-employed, so that can be an option. And also a simple IRA. A simple IRA allows both employer and employee contributions, basically deferral contributions. So those can be a way to use a type of IRA to save more for retirement, and the contribution limits are higher than they are for a regular IRA, for higher than a traditional or Roth IRA contribution. So those can be pretty beneficial, good to know about. Even be if you're participating in an employer plan, but you have a side business or something, you do consulting or something, possibly set something like this up for you. There's also a solo 401k, but that's another discussion. So there's options to consider if you have a small business or you are self-employed. So let's say your income was too high to contribute directly to a Roth IRA, and that's if your income is over 150,000 single and $236,000 married, starts the ability and the amount you can contribute starts phasing out. But you might hear about this backdoor Roth IRA. It's a roundabout way to get money into a Roth IRA if your income's too high. So what are the steps? You open, and let me just caveat, this works effectively if you have no other IRAs that have a taxable balance in them, meaning no pre-tax amount, whether it was from a rollover from an employer plan or you made deductible contributions to it in some years. So if you have no pre-tax amounts in any IRAs, you have to look at all of them, including the SEP IRA and the simple IRA and your traditional IRA, then this can work tax-free. So what you do is you open a traditional IRA if you don't already have one. You make a non-deductible contribution for 2025. That's either a max of $7,000 or $8,000 if you're age 50 or over. That fact that it was non-deductible gives you tax basis. So you hold the contribution in something like cash money market, so it doesn't really change in value because you don't want to do that here. Then days later, you convert it to a Roth IRA. The conversion value, so say you did 8,000, you contributed 8,000. That 8,000 conversion value is considered income on your tax return for the year you converted it in. But again, if you have made this non-deductible contribution, have no other pre-tax balances, convert 8,000 tax basis to go against it, it ends up being fully tax-free. So you had to flow it through your traditional IRA to get it into the Roth IRA because you're converting it from the traditional IRA into your Roth IRA. So it makes it non-taxable. If you have pre-tax balances, either all or most of it, some or most of it would be taxable when you do that conversion part. I will say we have a number of clients that have gotten caught on that because their investment advisor didn't understand that tax basis rule. So it's very important to understand how this works. So if you do have these pre-tax balances from rolling over employer plans or making tax deductible contributions, and you still participate in an employer plan that accepts rollovers, most do, but some don't, you can roll your IRA, your pre-tax IRA balance up into your employer plan to clear the deck to be able to do these backdoor Roth IRAs. So that can be a way to make it so you can do these every year tax-free. And certainly if it makes sense, you can just convert that pre-tax balance to the Roth IRA also. So it depends on your situation. Once it's in the Roth IRA, that's where you invest it. So that's where you want to invest it for tax-free growth. And then when you get your tax return done, make sure to bring this up to your tax preparer because they won't know if you just give them a 1099-R, they can't tell from that you did this non-deductible IRA contribution for tax basis. So make sure to put a note in with your tax information because there's a form that your tax preparer needs to use to report all this on and to get the tax-free treatment. I'm not going to go into this. There are 5-year rules on Roth IRAs as to whether the withdrawal is qualified, and that means whether it's tax-free and penalty-free. I just want to have it in here, but you can refer back to it when you get the slides. And if you're in that situation where you're looking to take a distribution from a Roth IRA, it's important to know these rules. This one I bring up, it really relates to employer plans. But it's also while you're considering your various retirement accounts and you're trying to manage it and you say, all right, do I roll over my employer plan to one of my IRAs? Is that something I should do? If you are age 55 or older at the time you leave your employer in this plan, and let's say you need the cash. You left before, because normally you can't avoid penalties until you're age 59 and a half, or you have you're disabled, or there's some other exceptions. If you need the cash, it might be better to wait to roll it over and leave it in the plan instead, because you can avoid the 10% penalty on employer plan withdrawals if you need the cash. So as long as you meet that criteria, 55 or older, when you left the plan or left your employer, then you qualify for this exception. And it only applies to a withdrawal from that employer plan that you were participating in when you left your job. It can't be a different employer plan from an older employer. You do still owe the income tax, of course. And it doesn't apply to IRAs. This only is an exception for qualified plans. But you always have to balance this with, okay, say I need cash now. It's not because you want to go on a big trip, or something. You need to balance this with the fact that you need to have funds for later in retirement. Maybe you can get by without withdrawing the funds from the plan and losing that tax deferred compounding. So these are just part of the considerations that go into all these things. All right, so the required minimum distribution rules during your life after we've had the Secure Act from 2019 and all the changes since then. So what is a required minimum distribution? It's the minimum the IRS says you must take out pre-tax, out a pre-tax retirement account starting at your required minimum distribution age. You can take more out than this amount, but it is at least the minimum that you have to take out to avoid penalties. Because if you take out less than this minimum, you'll have penalties. That 25% and 10% that I mentioned. The IRS gave tax for deferred growth all this time, but it is a retirement account and it's meant to be used in retirement. So they don't want to keep that tax, that deferral of tax going any longer. So that's where you have to start taking these withdrawals. So these RMDs, as we call them, are due the year you turn your RMD age, which is 73 right now, and again goes up to 75 starting in 2033, or by April 1st the next year at the latest. So again, for one, the next year is considered to be your required beginning date. But if you delay taking your first one until then, you'll have two in 1 year. You'll have two that year because you still have to take the second year's one out before year end. And so having two in 1 year, bunching them like that could push you up into a higher tax bracket. So that's just something you have to weigh up, or maybe your tax situation will be lower in the second year and it's worth waiting until April 1st for that first one. And only can wait until April 1st for your first one. After that, it's by December 31st at the year end each year. By then. You can wait until you retire if you own less than 5% of the business that sponsors the qualified plan and you're still working and the plan allows the delay. You have to go back to the plan document, check with HR and make sure the plan allows you to postpone taking RMDs. This only applies to that company's retirement plan, does not apply to IRAs. And your required beginning date is still April 1st of the year after you separate from service, even if your last day working was December 31st the year before. So you're down to that, okay, my last day is December 31st. You have to take an RMD, your first RMD that day, or by April 1st the next year, but again, you have two that year. So that's got to be carefully planned. Each year's RMD is based on the December 31st balance the year before, plus if you have outstanding rollovers or transfers that are crossing tax years, that have to be added back to it. And it's divided by a life expectancy factor, which you don't have to know. Your custodian calculates it, they're required to. So, and the life expectancy factor is assuming that you have, as if you're married, whether you are or not, and so it gives you a lower divisor for that. But again, your custodian calculates that. There's no required minimum distributions due from Roth IRAs during lifetime. So that doesn't apply to those. And knowing you have these RMDs coming out of your retirement accounts, as you get closer to it, maybe a year, 2 years, couple years out from that, and all throughout, it's important to plan your cash position accordingly inside those accounts, sort of like you have emergency cash reserves outside the account for anything coming up near term. You wouldn't invest that in the stock market because you don't have time to write it out when you need it near term. Well, taking your RMDs in a year or two is near term, and certainly each year. So it's important to plan that cash position inside the retirement account to fund that RMD, especially when you think of what we're in now, a down market. If you had to sell stocks to get the cash to fund the required minimum distribution, that would really hurt. And it also really impacts how long your money can last. There's a sequence of return risk thing out there that if you sell when things are down like this early on, it has a huge impact on how long your money can last. So that cash balance could be a buffer. And then you also might want to consider turning off reinvestment of investment income, interest, dividends, capital gains, so that you can accumulate and replenish your cash. Okay. And yes, we will be sharing the slides and the recording afterwards for those that have to head off or something. When you think of taking your required minimum distribution, let's say you have multiple IRAs, you don't have to take each one, the custodian calculates it for each IRA. Each IRA's portion doesn't have to be taken from that account. You can consolidate certain accounts and take it all from one, or however you want to do it. The ones that can be consolidated are IRA type accounts. So traditional IRA, SEP IRA, simple IRA, and these are all not inherited ones. These are yours. And then inherited IRAs, those can all be consolidated. Then inherited IRAs from the same decedent. So maybe they had multiple IRAs at different institutions or something. You can take them as long as it's the same decedent. You can take your minimum distribution from those from whichever account you want, any combination. You just need to take the right total. So what you do is you take the amount that the custodian adds up for each separate account, add it up. That's the total you need to take and you can take it from whichever account you want to. Again, not mixing in inherited accounts with regular accounts. The custodian is not required to calculate the inherited IRA RMDs. They might, maybe if you give them all the facts on it, they might do that for you, but it is much more complicated. Qualified plan requirement and distributions must be taken from that plan. You can't take it from an IRA. So those can't be aggregated with IRAs and vice versa to take the minimum. Okay, so a strategy. Qualified charitable distributions, QCDs. You can donate, you used to probably hear 100,000, but it's up to 108,000. You can donate up to $108,000, that's a 2025 amount, to charity directly from your inherited IRA or inherited IRA. To qualify, you must be at least age 70 and a half at the time you make the distribution. So not in the year you turn 70 and a half. You literally have to be age 70 and a half. So you'll notice that age was, I don't know, you might not notice, but that used to be the required minimum distribution age. So it tied, but it doesn't tie anymore. Now that stayed the same while the RMD age increased. So it's still 70 and a half to qualify to do this. You don't have to wait to 73 or 75. The tax benefit, you get a tax benefit even if you're not itemizing. So it's because it's not reported as income. That's your tax benefit. You can't also deduct it as an itemized deduction and double dip. By not including it in your income, it keeps your AGI and your taxable income down for other implications, such as Social Security taxation. IRMA apply as a penalty when you're collecting Medicare and your income's high. AGI floors, tax brackets, QBIs, qualified business income deduction, things like that. So it's very advantageous, even if you only contribute a little bit, to do it this way if you're at least age 70 and a half, to not have that hit your income. It only can come from IRAs, not ongoing separate simple IRAs, which means you're still contributing to them from employer type arrangements, working arrangements. It can satisfy your required minimum distribution without increasing your taxable income. That's pretty powerful once you do have to start taking RMDs, or if you're taking them now, that could be a great way to keep that out of your income. It can satisfy a pledge. There can be no quid pro quo. So the gift must fully qualify as a charitable contribution. You couldn't have gotten like a meal or some benefit. Cannot be made to a donor advised fund or a private foundation. So that's good to know. You can't make a QCD distribution to those. And you do need to balance it with the advantage of gifting appreciated stock out of a regular account. So, should you do the QCD, or if you have highly appreciated stock, maybe that makes more sense because you forever avoid the capital gain as an added tax benefit. So again, never do anything in a vacuum. It depends. It should always depend. It depends when answering personal finance questions. Okay, so QCD Secure 2.0 Act changes. As I mentioned, the $100,000 limit is getting indexed for inflation. So for 25, it's up to 108,000. And again, it is reduced by any traditional IRA contributions you make after age 70 and a half. Roth IRAs never had that. And there is this one thing. It's a one-time $50,000 QCD distribution you can make to a split interest entity, which is a charitable remainder trust or a charitable gift annuity. Disregard the charitable remainder trust. The way the rules work, you would never do this. It is part of your 108,000, and it still counts towards your RMD, but it has to be funded exclusively with the IRA funds, can't be mixed. You can put personal assets into this. So if you thought you could do a charitable remainder trust with this 50,000, it can't be mixed with other asset. It has to be totally on its own, which you never form a charitable remainder trust, which is 50,000. Charitable gift annuity is a possibility for that dollar amount. Only the IRA owner and spouse can be beneficiaries of it. All right. So also might not be what you want. So another strategy. So again, I mentioned some people say, oh, my future RMDs are going to be high, I am pushing me into higher tax brackets. I want to reduce those amounts that I'm going to withdraw now to get it into my tax situation now in the hopes of minimizing the impact later. A Roth IRA conversion could do the same thing, even better. So it can help you minimize those future RMDs, both in amount and the tax impact to you and to your heirs when they inherit the account, based on those rules that I went over earlier. Yeah, the 10-year payout, that's where a Roth IRA conversion benefit really comes in. So Roth conversion accelerates the income tax, yet keeps the balance in the retirement account wrapper, so you're not having to pay tax on the earnings. And it reduces the amount that would be subject to RMDs going forward. It can be beneficial if you don't need the IRA for doing QCDs, or you've named charity as a beneficiary on it. If you haven't named charity as a beneficiary on it, so if you don't need it for QCDs or you're not leaving it to charity, this can be beneficial strategy. Or if your RMDs could push you into higher tax brackets later. You can save tax by shifting some into the lower tax rate years, or maybe that we think the rates are going to go up later and these are lower rates. For estate planning, if you may not need the RMDs or the balance during your lifetime, and the beneficiaries would have a high tax burden under this 10-year payout rule with the Secure Act, or maybe you have a taxable estate, because when you do a Roth IRA conversion, the amount you convert is taxable on your tax return, and you pay the income tax, but it's like and then you're leaving your beneficiaries something more valuable because they're getting something that's going to be tax-free. You're essentially paying the income tax for them as a tax-free gift tax-free. And you're freezing its value for income tax purposes because it will forever, as further growth happens, it will be subject to income tax. Another consideration, if you will be subject to IRMA, that penalty on Medicare premiums later, if you have high income, shifting some into these lower years can be beneficial. Also gives you tax diversification of your retirement savings accounts. Maybe then you'll have some pre-tax, some tax-free, but you have to have extra cash available to pay the conversion tax. That's a key point to note. And you don't want it to put you in a cash bind. So this has to be extra cash that you can use to pay the conversion tax. So good timing to make this conversion could be low income years. Often it might be when you first retire, before your RMDs start. There could be a few years in there where you have very low income. Or if your current tax rate is likely lower than it might be in the future. Or maybe you have some things hitting in a certain tax year, like you have large business losses. Maybe you did a cost segregation study for accelerated depreciation, gives you a big business loss. Or maybe you're making a big charitable contribution, or you're funding like a charitable remainder trust or something, and you give a big charitable contribution. Bunching and Roth conversion in those years can really hedge your bets. So those are good times to consider it. Also, if with us being in a low current tax rate environment, rates are historically low. Who knows? With that will get extended for another 4 years, but then who knows what'll happen after that, if it does. So we just don't know. Rates could be higher later, and this could be a great time to do it. And we're also in a down market, that's for sure. So that can be a great time to do a conversion, because you can either convert more units for the same amount, or you can convert the same units for a lower value because the value is down. So that can be a good time. There's benefits to a down market when you look at it right. So integrating your IRA into your estate plan. So these are considerations when naming beneficiaries. These accounts, this is good to remember, a lot of people don't realize this, these accounts pass by beneficiary designation, not by your will. So it's important that you name primary and contingent beneficiaries, and it's in keeping with your wishes. You continually review it, and you're taking advantage of any tax benefits based on how you structure it. You might want to consider naming your spouse's primary beneficiary, especially for Roth IRAs, since he or she has more flexibility under the Secure Act. I think that will be more covered in session number 2 on May 15th. But they have more options when inheriting an account than a non-spouse beneficiary. Consider naming eligible designated beneficiaries, the four categories listed here, or trust for their benefit on separate retirement accounts if you need to, even if you name the spouse as primary and these separate individuals as contingent beneficiary, or again, if you name a trust that benefits all of your contingent beneficiaries, that's fine. So it doesn't taint the stretch option that I talked about earlier in the beginning. Now that few qualify for the stretch, we used to think we don't want to name charity as beneficiary because you lose all the benefit that family members could get for being able to stretch it, all that tax-deferred compounding growth over their lifetime. You might want to satisfy your charitable bequest now with your IRA because that 10-year payout doesn't give you much compounding. You can name charity as beneficiary of the IRA rather than maybe putting it in your will or a revocable trust or something. And leave other assets to your heirs. The charity gets it tax-free because they're a charity. And it's easier to change your beneficiary designation than it is to get your will or your revocable trust or something changed. You have attorney's fees and it's just more involved. So as things change and your goals change, you can change the beneficiary designation on your IRA to name different charity, different amount, however. But note that it might be better to make that charitable donation during life, so you not only reduce your estate, but you also get an income tax deduction. This can be used to satisfy goals for bequests at your death by naming that you might have a certain person you would wanted to name in your will to get a certain dollar amount or a certain percent, certain dollar amount. Maybe you segregate an IRA for them. No, the balance does change, but as long as you have to monitor that. But maybe you name them as beneficiaries, so you don't have to keep updating your wills and will and trusts for a different amount and all that. So you can carve off something for a certain somebody you want to leave that you otherwise would name in a will or irrevocable trust to get a bequest at your death. That just give you more flexibility and simplification to do that. You can consider naming trusts as beneficiary if you carefully structure it. Note that minor children or grandchildren, if you think of your contingent beneficiaries and how that might be structured, cannot inherit retirement accounts or can't inherit financial assets if they're under 18. It creates an awful mess that I've been involved in. Attorney brought me in because you get the courts getting involved, naming a financial guardian, overseeing. You have to report how every dollar gets spent and limited what you can invest it in. So you really don't want a minor inheriting financial assets directly. So you might want to use a trust. Similarly, if you look at your beneficiary dozen, there's primary and contingent, and there can be a box that you check for contingent that says per stirpes. What that means is if you predecease, the primary is gone, and then you're gone, your share could go down your line to your children. But what if they're minors? Now you're in this boat. So you might want to name a trust in the contingent beneficiary section to benefit minors. It has to be a certain kind of trust. And I mentioned that, I mentioned it earlier. To save estate tax might be another reason to name a trust. If you don't have enough other assets to maximize your estate tax exemption, maybe the retirement account's the only asset you can work with to make sure each spouse uses their estate tax exemption. For instance, New York's 7 million-ish amount. Or you want to control when and how much beneficiaries receive in IRA funds. Like I said, that 10-year window is a short amount of time for them to get a lot of cash and might be sooner than you want. It also controls who gets the balance. Maybe you have kids from a first marriage and you want to know that after the RMDs of your spouse or something are satisfied, it will go on to your children. Be sure the trust has a provision prohibiting the IRA from being used to pay estate tax or debts of the account owner. I mentioned that earlier because that causes a different payout rule. Review regularly, be sure they still align with your wishes. Oh, good, got through it. All right, so I want to see if we have any questions. Action items. Okay, so sure to okay. Yes. So please, if you have any questions, put them in the chat. I'm not seeing anything in there but if you have any, please feel free to put them in there. Otherwise, there's my email address. And again, you'll get a copy of the presentation once we get that compiled. It'll be the presentation slides and the recording will be emailed to you. So if you need to replay any of this to get clarification, make sure you heard something correctly or you missed the beginning of the presentation, that can be a great way to kind of get yourself caught up. Is there any truth to the Trump plan to make Social Security non-taxable? Everything's up in the air. It's so hard to say what's going to happen. I know you want to weigh in on it. Can a conversion to a Roth be considered part of your RMD? No, it cannot. So you still have to take your RMD. So this will be something completely separate. And your RMD cannot be converted. So if you have an RMD 1 year of, I don't know, 10,000, that amount cannot be part of the conversion. As a dual citizen, UK and USA, how do the IRA rules apply? I can't really speak to that. If you're everything as a US citizen, I can't speak to the UK part, but as a US citizen, as you know, you tax on all you follow all the US rules. You tax on all your worldwide income as a US citizen. So if you do a Roth conversion, that conversion would be part of your taxable income. You have to take RMDs, you got to follow all the same rules. But maybe there's a credit from also paying something in the UK. It could be foreign tax credits. Okay, any other questions? We're coming close to time up. Weighing in about the tax, the tax rules, the 2017 tax law that brought us these low tax rates. So it's not just the tax rates that's rule is supposed to sunset that law at the end of this year. Trump is trying to get that extended. If he does, maybe we'll have it for another 4 years or 2 years. Who knows? We'll have another the House and Senate changeover in 2 years. So we don't know what could change. But if it does get extended, we don't know what will happen afterwards. But if it does sunset or sunset soon, it's not only the tax rates that go back up, but it's the brackets. The tax brackets had widened under this 2017 tax law, which allowed more income to be taxed down in the lower brackets. So if we go back to the law before 2017, those brackets narrow, pushing more income into higher brackets, and the rates on those brackets go up. So we're in a quite good tax rate environment right now. Is the rollover IRA the same as a traditional IRA? Yes. A rollover IRA and a traditional IRA are taxed the same way, as long as they don't have any tax basis in them from making non-deductible contributions, but it would be the same if you did that in your regular IRA, traditional IRA. After the RMD has been taken, is it better to withdraw from the IRA or taxable accounts for charitable contributions? That goes to that question of you can still also take more from your IRA for a QCD if you haven't met that $108,000 limit per person. So spouses, you can do double that. And so you could do it from there if that makes sense. It depends, or does it make sense to give appreciated stock or appreciated securities of some kind out of a taxable account? That depends. So that is the question that needs to be looked at. These are great questions, everybody. Any others? All right. Well, we're about at time. So if any other further questions pop up. Oh, wait. If the rollover IRA does have basis, is there a difference from traditional IRA when calculating the RMD? Not for the RMD. That still has to be calculated. It's your total IRA balance. But when I was talking about that backdoor Roth IRA, that tax basis gets spread amongst all your IRA types that are pre-tax. So traditional, SEP IRA, simple IRA gets spread amongst all those balances and comes out pro rata. So you can't say, oh, I just put 8,000 in this account and I'm not deducting it. I have 8,000 for this conversion if you have 100,000 in another taxable account, another pre-tax IRA balance. So that's important to know that that's why that conversion wouldn't be fully taxable. And the same applies when you're taking RMDs, a portion of that basis comes out. All right, I think we covered a lot of material. So hopefully you guys walk away with something that was helpful. All right, be on the watch for email with the slides and the recording. Thank you very much. I hope you guys have a great day. And I'm hoping you guys all learned something today. All right.